All right, what's up, folks? Welcome to the first webinar of the week here. It is currently Tuesday, February 26th. And we did not have a webinar on last Thursday because there weren't too many trades to recap. Remember, Thursdays are recap days, but overall, right, we've had a great week so far. We've got a lot of fireworks, and a lot of that, and Friday's action, which was arguably even better, were a result of just earnings plays, right? Really simple to kind of categorize the majority of the movers that played, earnings plays. And there are two setups that we trade pretty frequently for earnings movers, but we trade it for various tickers, right? These techs apply to everything, as we always mention. So for the most part, I want to go over these just because we still do have some earnings that are coming up, and I think this is the best way to kind of recap what happened on Friday and yesterday. But on top of that, hopefully this makes things a little bit easier for you guys to understand, and also spot it on your own, right? The whole goal of what we do in chat is so that you can be a little bit more independent, and so that you can understand why these tickers are moving. And I think this webinar will fully cover that. Okay, so earnings are a very tricky topic, especially for people who are new to investing. I'm not going to say trading, because the most common thing for a long-term investor that I get asked is why a stock sold off on good earnings, or why a stock is up on bad earnings. And people don't really understand the different things that factor in to an earnings report. And that's because a lot of what we trade and a lot of the stocks that are frequently mentioned in chat are movers that are pretty hot and they're pretty popular. And 9 times out of 10, their moves are priced in beforehand. So typically you can justify a lot of these earnings moves and reactions with what has happened before, right? If we have a stock like TTD, for example, that runs up ahead of earnings, it almost always runs up into the earnings report because it almost always beats expectations, crushes those estimates, and it's a very high growth name, right? You guys remember that on Friday. So 2 earnings reports ago, not the most recent one, on TTD, initially it dropped down a good bit because it was already priced in, right? It ended up bouncing back, but initially it did drop down. And you can see that was right here. Okay, now you can see that before this most recent earnings report, it broke out and ran up, and then it crushed estimates even better than last time and flew to a new all-time high. So the first thing that I wanted to cover for this, and I'll just list both of the setups right off the bat. First thing is a breakaway gap. That's a pretty common term that is used for these kinds of earnings gaps. But I'll explain that a little bit more thoroughly in a second. And then the second one is a gap fill. Now, if you don't understand gaps, then this webinar is going to be kind of tricky for you. It sounds more advanced because gaps aren't too commonly mentioned unless you're really an active trader. But gaps, essentially the way they work is for mean reversion, right? Mean reversion is when we go back to doing what we do on a standard basis. So, for example, one of the most common examples of mean reversion is when we are trending and then a stock drops down significantly, or even, right, if we're in a bullish trend and the stock spikes big time, right? It's actually likely to come back down and then revert to back what it was doing before. That's a very standard example of mean reversion. Gap fill works the same way, where if we have a gap significantly in one direction, even if the earnings were bad and we gap down a lot, it's a very common thing that you see, right? Let's say this was the closing price from the day before and we gap down here. It's very likely that if we break through the high from that gap down, that we're likely to fill that gap and revert back to what we were doing before. There are a lot of reasons this is tricky, and again, we'll get into that in just a second. But the first thing I want to talk about is a breakaway gap. And you don't really hear us talk about this term that much in chat because I don't really like the term that much. Breakaway kind of has this connotation where it's saying that it's breaking out and that it has to continue higher. I don't like that because I think that really for these breakaway gaps, what's important is that a stock continues to break out, and price confirms the next leg up after it's already gapped up. Because if you took any stock, right, let's say TTD, for example, for a buy, right, if you took it long after a big earnings gap up, so you could see TTD only had a $16 implied move. If I remember, it gapped up almost 30 bucks, so 150 to 175. So that's about a $25 gap. That's very overextended, right? Very overextended. And just from a simple percentage standpoint, right, proportionally, this is a much larger number than 16. I think it's pretty obvious, okay? So naturally, if you take every single stock that has a big overbought gap up long, you're going to take a big loss, right? That's why I don't really like this term breakaway, because what that means is that if we get a gap up way above resistance, that you automatically take it long. And as you guys know, resistance and support work as zones. They work as supply and demand. So if you're taking every single time we break resistance long, you're going to take a big loss because there's a very good chance this will reverse on you. So TTD had a blowout quarter, right? Had very strong earnings. And we're not going to go over how to interpret an earnings report, but basics of this, right? It beat on EPS estimates. It crushed, right? Let me just say crushed. It crushed EPS estimates. It crushed revenue estimates. And then they guided up for upcoming sales. So they said, we made a lot in profits, we made a lot in sales, and we intend to sell even more over the next year, right? And really up to the next quarter. So TTD, with all of those bullish mentions, gapped up to a new all-time high and then kept running. And I didn't specifically trade this one because I traded Roku instead, but we're going to use that one as an example for just in just a second. But really, the common thing that you see from a breakaway gap is just strong earnings and a gap up that is so large, or at least so meaningful, that it's breaking out over resistance. So breakaway, right? It's breaking away from where price is concentrated or where resistance is sitting at. Okay, so in this case for TTD, if we look at the daily chart, right, we know we got strong earnings, and the daily chart resistance is all focused around here, 149 and 165, and we opened up here. Pretty damn far. All right, pretty damn far. So overall, that's a breakaway. There's no getting around it. And it's on watch, right? Because it had strong earnings. And as you could see, the stock continued to break out. There is no standard, and I want to make this very clear. There is no standard for the price confirmation that gets you into the stock afterwards. Okay, let me simplify this a little bit. So we talked about strong earnings. We talked about a daily chart breakout, so the 1 year, 1 day with the overnight gap. Okay, and typically we're playing long side trades here. We're not really looking to short something into the lows that frequently. Earnings have to be pretty bad for that, and usually they'll be priced in beforehand. But there is no price confirmation that is universal here, right? So there's no saying, okay, if we break the pre-market high for any of these plays, we go long. That's a common one. That's not universal. Okay? The resistance levels that you're looking at cater to this stock specifically. Right? So if we're looking at TTD just from a real simple standpoint, you can see that it did not have any other resistance. The only resistance was the pre-market high. So that's what you wanted to break out over. And for what it's worth, the first resistance was up here at 191 after that. Okay, so second resistance, technically. So the confirmation for TTD would have been a break of the pre-market high. Okay, again, that's not universal for everything. A lot of times we'll have other resistance levels that we need to break, and I'll show you an example of that right now. But the breakaway gap, pretty simple. You need strong earnings, and you need to break out on the daily. Okay, if you're unsure about the second part, because that's obviously the part that requires more experience, then just ask, right? Ferris or Dennis or Angela, is this thing breaking out on the daily time frame? All right, but TTD, as you can see, continued that run up and then kept going. All right, same thing for XLNX. You guys probably remember that one. Another breakaway gap that played out very well and then actually kept running up for weeks and weeks and weeks. Right, made it up to our $120 price target. But the other example I want to use is Roku, because a breakaway gap is not just represented by a stock going to a new 52-week high or going to a new all-time high. Remember, the key here is a daily breakout. So the common thing that people think of is a new 52-week high, a new all-time high. But daily breakouts can happen in various ways. It's not just saying that we have to hit a new 52-week high to break out on that time frame, right? It's the same thing as if we were looking at the hourly chart. If we're saying a breakout on the hourly, that doesn't mean that we're hitting a new high on the hourly. It could be a trend line breakout. It could be a breakout of a previous resistance level on the hourly. It could be whatever, right? So it does require an eye in order to catch that. All right. Now, Roku was another perfect example of a breakaway gap. And I will say, overall, the breakaway gaps on Friday were very aggressive. And I'll tell you why, because I don't want you thinking that every single breakaway gap is going to result in a massive move. Usually they have higher momentum, but the ones that we had on Friday were TTD, Roku, and IQ. You have to keep in mind that IQ had China news that day. China stocks were already ripping. Okay, all three of which had blowout quarters. They had great earnings. TTD was breaking to the all-time high, so that's going to bring more buyers in general. And then Roku is a high short interest name. So each one of these required a little bit further analysis, but this is why they made bigger moves. It's not because they had breakouts. That's part of the reason. The other part of the reason is that they all had individual catalysts that were working for them too. Okay, so IQ exaggerated the move because of the China news. Roku has a higher short interest, so it's more likely to squeeze. And TTD was pushing to an all-time high on a blowout quarter. All right, so Roku, let's rewind it back to Friday. And this made for an amazing Friday. But Roku put in a pretty standard move, and I actually don't want to show you the intraday text too much. I just want to show you key levels and how exactly this played out. But let me pull up pivots and then take off the other studies here. I just want you guys to look at pivots, that's it. All right, so Roku was a stock that was gapping up and had a breakaway gap, but it did have some resistance intraday, right? And really just resistance on multiple time frames. If we look at this gap, right, we already had a game plan going into Roku. We were either going to go long off of 45.80 or nothing, right? Depending, if there were strong numbers, we were looking for a dip buy here. If there were weak numbers, we were going to short it up here. That was the game plan. But at the moment, Roku had a pre-market high at 55.30. Okay. Again, blowout quarter, it's gapping up. It bumps its head on 55.30 a lot. Naturally, you look at this chart and you go, oh, right? Obviously, 55.30 is the key break. But there was one other kicker here that made this a lot easier to read. And that was the fact that 55.27 was the big resistance on the daily. That's that yellow line. If there's one thing that we've covered in recent webinars pretty extensively, it's confluence areas, right? Overlapping key levels. So in this case for Roku, right, you can see that both of these levels overlap. They're just 3 cents away. That's nothing, right? They're very, very close. So right there, that's your first key level overhead. Okay. Now we also have a pivot, and then the next daily fib, another pivot, another daily fib, all the way up. And they're pretty spaced apart except for these two key levels. So there's enough upside for multiple scalps here if it does continue to break out. But bottom line, that's the big key area. And notice we identified this by using this week's high. That was the level, along with the pre-market high. So again, we have a breakaway gap here, but the key break for an intraday signal is specific to this stock. Okay, that's the point that I want to make. And Roku, you could see once it broke that level, it was on. Okay, went up to the next target, went up to the next target after that. Once it broke the next target, it started moving towards the next one, but the last one was in the 66s, which was very, very far away. So it did end up hitting that on Monday, which was the following trading day. All right, so you can see this was target 1, 2, 3, 4. It did make it all the way up to that move. But for the most part, right, it just had a crazy amount of momentum all throughout the day on Friday. Okay? And again, you're not marrying this and just going long at the opening bell and hoping for the best. You're waiting for that key intraday break before getting in. All right? Now, the last thing I wanted to mention for the breakaway gap is that 9 out of 10 times, these tickers are going to make it to the strong earnings mover watch list. If you don't know what that watch list is, I'm actually not going to explain it. Because if you've been in chat any day in the past 2 weeks, we've mentioned this every single day. We've had this watch list for years, right? And we maintain it constantly. So this is something I don't really want to go over too much because I don't want to hold your hand too much. But 9 times out of 10, these do get added to the strong earnings mover watch list, which is beneficial for one big reason. And I'm actually going to ask you guys that. That's the only question I'm going to ask during this webinar. Why is it valuable and beneficial to us for a stock in general to be added to the strong earnings mover watch list? Technically, the question is really, not necessarily why is it valuable, but what is the point of this watch list, right? What is the point of maintaining this watch list? Why do we even want to have it in general, right? And frankly, right, the big reason is for opportunity. That's it. Opportunity, right? If we're talking about maintaining watch lists outside of intraday watch lists, right? We're talking about watch lists that we check on weekly or daily or monthly, whatever, for, bigger picture setups or strong earnings or whatever. A couple of the common ones that we talk about here are the 90 to 120 watch list, right? If you don't know what that is, we have a blog post on the site about it. And then also the strong earnings, right? Which actually I already have it written up there, so I don't need to rewrite it. But bottom line, these watch lists are maintained for the purpose of getting more opportunity later on. It's a simple answer, right? So Dave mentioned to maintain focus on it from earnings to earnings and watch it for a continuation. Penn said because it'll set up again. Not guaranteed, but very likely. And Ali said for a future earnings move, right? So naturally, these tickers beat regularly because they're growth names and they're, blowing out earnings expectations regularly. And on top of that, if you think about it, right, the biggest financial impact, unless there's some other thing going on with that company, the biggest fundamental impact that is had on a stock comes from the earnings report for a full 3 months, right? It's quarterly, so full 3 months. So that means from this point on for the next 3 months, assuming all things stay the same, which is almost never the case, but we're very likely to get another bullish move. Very likely, right? It's almost guaranteed in the sense, but there is no guaranteed move in the stock market in general. So that being said, we add these stocks to the strong earnings mover watch list, and we watch them the next day, the next week, the next month for another setup. Okay? Now, specifically, one of which, and I added all 4 of these. So I added TTD, Roku, W, and ACIA to that watch list on Friday. So I added all 4 of those to the watch list. I only traded one of them on Friday. Again, you're not trading every single one. You're just looking for more opportunity. But for the most part, one of these was my first win on Monday. Right? Look at Wayfair. Actually, we can look at any of these on Monday, but Wayfair, the big resistance was just Friday's high. That was all we had left because it had already broken out. So this was Friday's high. I'll put it in yellow, actually. Why is another level coming up here? All right, that's Friday's high, and you can see on Monday, Wayfair broke through it. We took it for a long scalp at 157.9, and the stock went up to what? 162.74. I think I got 4 points out of it, but it went up as high as 162 and some change. Okay, and all this was setting an alert above that earnings high, and if it broke it and held, I took it long, and that's exactly what I did. And you can see that it's still going. Right? You know how frequently shorted this stock is, or how heavily shorted, I should say. It's unbelievable. This stock has a very high short interest for a large cap, and I'm saying that because just by this logic and just by maintaining a watch list and looking at an earnings report, not only are we making money, right? Not only are we actually profiting, but we're on the right side of the damn trade, right? And that alone is priceless. That means that even if we poorly execute, we're very likely to make money. And even if we just don't even trade it, we're not losing money, right? This stock is very, very heavily shorted, right? I can't tell you how many people I've even seen on social media with a decent following call this stock out short on that earnings day and then afterwards. And they're probably holding bags right now. So the whole point here is not only to profit, but to stay on the right side of the trade and be able to spot these setups on your own. Okay, so quick review of this basic earnings setup called a breakaway gap. You can call it that in chat, but again, really what you want to refer to is the analysis for it. So call it like you see it. Say it had strong earnings, if it did, obviously. And then call out what the daily chart breakout was. And if you're unsure about this part, then just ask. Right, just ask. We had a ton of tickers break out on Friday. They worked very, very well. And actually we added 5 to that list, but overall was a very profitable day, and then that resulted in a profitable Monday, right? Wayfair was one of my top gainers. All right, and then the last thing I wanted to go over, this one is super short, super simple. It's just a gap fill. Now, commonly when we're talking about a gap fill, what we're referring to is a gap fill on the daily. Right, we're talking about when we have, and I think Roku might be a good example here. When we have a gap on the daily, right here, and we break this lower end, we're signaling a move to the upper end. It's as simple as that, and it works in both directions, right? So the basics of a gap, that if we break into that gap, we're very likely to fill it and run up to the upper end of it. And again, also works to the downside. So based off of that, we're applying that same logic to the overnight move, right? Prime example here is Shake Shack. Prime example. Shake Shack reported strong earnings and gapped out. And let's just annotate that overnight gap with a rectangle. So what we're doing is we're going close to open. That's how we draw the gap. The gap is not from high to low, it's always from close to open. So in this case, that is from here to here. And I'm going to extend it sideways so you guys can see when we filled the gap. All right, but it's here to here. And I'm going to extend it sideways. Oh, it disappeared. All right, and you can see exactly when Shake Shack filled that gap. So again, a reported strong earnings. So you need it in the opposite direction of the gap in terms of the earnings that you want to see, right? If it gaps down, in order to look for a gap fill, you want decent earnings, or at the very least a support test. But strong earnings, right? And then an early red to green move. Ideally, this is off of some kind of support on the daily chart, but these are the two basic parts of it. So Shake Shack reported strong earnings, gapped down, and then went red to green early on. And you can see immediately, there's the red to green crossover with some volume, and the stock went straight up to that gap fill. Okay, Doesn't look like a massive gain, but this does happen pretty frequently, and it's a pretty clean-cut move. So once we fill that gap, you don't go long, you don't hold any, you cut it loose. Even if it keeps running, that's fine, but that's how you trade it. Red to green, and then take it to the gap fill. A lot of times we will just charge right out of the gates and fill that gap. I don't like trading that as much just because, it's not as clean of a signal, right? You're just chasing at the open, but for the most part, this is a better way to play it. So in total, your gains here would be from 50.4-ish. Let's say you had poor execution, up to 52.3. So $2.10. Obviously, you guys know what I was trading. I was not trading this ticker at the opening bell. I looked for a dip buy after hours. I couldn't get filled on one, so I just canceled it and I left the stock alone. But this is a very standard gap fill on earnings that are in the opposite direction of the overnight gap. Okay. And I know we spent a lot of time on the breakaway gap. That's mainly what I wanted to cover. But the two setups, breakaway gap and a gap fill. Both of which super simple. Both of which require strong earnings, especially if you're playing a gap down for this one. You can play it in either direction. But the breakaway gap requires strong earnings. And on top of that, some kind of daily chart breakout. So the 1 year, 1 day. All right. If you guys got any questions on either of these two setups, again, I guarantee you will see another one this week. But if you got questions, feel free to ask. And for the most part, right, every single time we have a webinar, I say try to take something concrete away from this. Try to apply it to what you're doing intraday. Your goal for this week and next week is to spot one of these and call it out in chat. That's your goal. Okay? To either spot a breakaway gap or spot a potential gap fill on earnings and call it out in chat. That's how you actually apply this, and that's how you digest the information and use it further. Okay? So again, any questions you guys can go ahead and ask. I'll stop the recording there.